Hello everyone, welcome to today's US Open live session. It is Tuesday, February 27th, 10 minutes before Wall Street opens every Tuesday and Thursday. I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. It is a data-heavy week. We already had CPI inflation out from Japan. And overnight, we expect the Reserve Bank of New Zealand to announce its latest policy decision. And of course, we expect US GDP on Wednesday and over the following days, inflation updates from both the United States and Eurozone, all figures that will affect monetary policy. And within all that, of course, I want to take a look at Apple because the mobile giant is facing increasing challenges. The latest one comes from Samsung, which announced a smart ring, a new wearable in the health and fitness tracking sector, which is dominated by Apple smartwatches, but this could now change with Samsung's new upcoming product. Before we begin, however, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and disclaimers carefully, and please bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. Having said that, let's jump right into it. We're going to start with the US dollar versus the Japanese yen and the inflation figures we got from there at the start of the day. We're gonna then cover the euro dollar, which shows indecisions at critical tech levels. Then we're gonna talk about the Kiwi and the upcoming decisions by the Reserve Bank of New Zealand. We're of course going to check the Nasdaq 100, which remains upbeat after the AI and Nvidia boost last week. And as I said earlier, we're gonna finish off with Apple, which lacks innovation, and that makes it lacking growth, and that could be a potential problem for its stock price, which has already been outperformed its market cap. It's now the second most valuable company behind Microsoft. So let's get right to it. We got the Japanese core inflation. As you can see on this graph from TradingView here, inflation has been decelerating after hitting 4-decade peak up here around a year ago. And the trend continues with today's January data at 2%. However, that's the last figure. It came in at 2%. It was hotter than forecast and above the central bank's target, or at least in line with the central bank's target. This seems to reinforce market expectations for a BOJ, a Bank of Japan, exit from the negative rates and ultra loose monetary environment, and likely this is seen likely occurring in April after the outcome of the wage negotiations, because a pickup in wages is critical for the Bank of Japan for sustained inflation. They want to create a positive wage price spiral. Now, as a result, the pair, the USD JPY, faces some pressure today, as you can see on the chart. Let's switch back. This is the 4-hour chart as usual, And this pressure creates a scope for further correction towards the 200 period EMA at around 1486, and along with the RSI moving, breaking below the 50 line. And of course, we have the Fed that is looking to start cutting rates this year. So if both those banks move towards opposite directions, one towards tightening and the other towards easier policy, we could see a pricing and a fall of the pair, but so far that has not materialized. In fact, the Fed has pushed back against aggressive market expectations for lowering rates, and markets have adjusted to that. They now see that process starting in June from as early as March previously, and leading to reading rates 75 basis points lower this year. Whereas the Bank of Japan is reluctant to normalize policy, as it wants to make sure it has achieved 2% inflation target in a sustainable and stable manner, together with wage increases, as we said. As such, the pair has extended its gains this year and is now within striking distance of the July 1990 highs at 152.2. But further strength does not look easy. For one thing, because there are prospects of the Bank of Japan and the Fed both pivoting. If they do, that would lead the pair lower. That's conventional wisdom, at least. That's the normal expectation. And because at this level, there is always the potential for verbal intervention or even an actual effects intervention by Japanese authorities. Of course, the next leg of the move will be determined by the incoming US releases. We expect GDP update on Wednesday and PCE inflation update. Important metrics, especially, of course, the inflation figures. They have shown persistence, but overall they have dropped. And the economy is performing very well. GDP rates have outperformed, and that puts the Fed in a position to not rush rate cuts. Now, let's go to the euro dollar. It tries to maintain its recovery momentum at critical technical levels. It has reclaimed the 200 period EMA and tries to move past the 38.2% Fibonacci of the last leg down. That would bring 1.1017 resistance in the spotlight, but it still looks far, and the upside generally unfriendly. The common currency does not inspire confidence, and we can see that it already shows indecision at this critical level, the 38.2% Fibonacci. And the ECB, although more hawkish in its rhetoric, it probably is a better candidate to start removing some of the monetary restraint given the weak economic conditions and, of course, progress on inflation. We're seeing that, as we said, that the 38.2% Fibonacci, we're seeing some reluctance there, and a new rejection would keep prospects of new 2024 lows in play. These are located at 1.694, although sustained weakness towards and beyond 1.0634 definitely has a higher degree of difficulty. Of course, as we said, we expect US data, but also inflation update, CPI inflation update from Eurozone on Friday. So definitely this could shape the trajectory of the pair. Now, let's go to the New Zealand dollar versus the US dollar. And of course, if there are any opinions or comments on what we discuss, feel free to share them by typing in the chat box, or if of course there are any questions. So why we're looking at the Kiwi? Because we expect the Reserve Bank of New Zealand to announce its policy decisions, the first since late November. Back then, it had kept rates at 5.5% for 4 straight meetings, but had adopted a hawkish rhetoric, with officials being wary of ongoing inflationary pressures, and had raised their forecast, expecting the official cash rate to peak at 5.7%. Which leaves room for another hike. With inflation far from the 1 to 3% target at 4.7% in Q4, there may be room for further tightening. In his parliamentary testimony this month, Governor Orr repeated this message around inflation remaining too high and policymakers worry of inflation pressures. But on the other hand, the CPI print we referenced was the lowest in more than 2 years and below the central bank's projections. And expectations also dropped in the bank's latest survey. While, of course, economic activity is weak, the central bank is expected to sort of flatline. So baseline forecasts are for a hold at this meeting, but we could see renewed hawkish commentary. Now, in terms of the Kiwi, we see a rebound after the 2024 lows. And above the 200 period DMA, the black line on the chart, the Kiwi has the ability to push for higher highs, but the next major resistance area at around the highlighted the timing and extent of rate cuts, the pair could drop to new 2024 lows located at 0.6037, but sustained weakness past that point definitely has a higher degree of difficulty. And with, of course, the RBNZ decision and the economic releases from US will be pivotal here for the pair as well. And with 3 minutes into the US session, let's turn our attention to the Nasdaq, which has largely overlooked the repricing around the Fed, as markets now await the first cut in June, as we said, and only 75 BPS of cuts. The reason behind the new record highs is Nvidia's blockbuster results, which renewed optimism around artificial intelligence. Nvidia reported record top and bottom lines and forecasts around 240% increase in revenues for the fourth quarter, and sees fundamentally excellent conditions for continued growth to 25 and beyond. The index seems poised to set new record highs, but perhaps if those lower expectations around the Fed sink in, and of course, again, we expect the inflation figures, if they show further persistence, this sentiment could change and we could see another pullback back towards the 200 period DMA, but strong catalyst would be needed for daily closes below it, which have been avoided. And in any case, the downside appears well protected, with a rising daily Ichimoku also following. Of course, there's not much to say technically about the indexes, since it's largely in uncharted territory, but there's definitely risk for pullback. And now let's turn our attention to Apple. The company expanded its wearable offerings with the augmented reality, mixed reality headset, or spatial computing, as it says. This is an effort to innovate again after 10 years and the first smartwatch. It does look like a technologically impressive device and superior than anything there is out there, and much better pass through, a key characteristic of such headsets. But the market is still niche, and there are, of course, physical limitations to it. Having bulky headsets on your head is not particularly enjoyable, and Apple's 3500 price tag is prohibitive for mass adoption. So, in the meantime, other companies have been innovating from foldables to all sorts of things. And now Samsung makes an entry into smart rings, a market that could explode in the next few years. There are already some noteworthy options there with the Oura ring, but there's definitely room for growth, and a smart ring seems more attainable and a more mass ready product. And of course, this new product comes hot on the heels of Samsung's artificial intelligence push. It unveiled earlier in the year AI-powered flagship smartphones, while Apple remains coy around it. Earlier in the year, CEO Tim Cook said that the company will update share progress later this year, but a late entry into the AI arena could lead to a significant handicap. There are also other companies making progress on various fronts, like Xiaomi, the Chinese smartphone maker, which plugs in to the EV segment, we could say, with its recently unveiled electric vehicle, and pushes for a highly connected future with the human car home smart ecosystem. And of course, Apple hasn't unveiled any such plan, despite being rumored to eventually offer an electric car. So all that brings us to the crux of my point, that Apple is not innovating and needs to find a new growth source in order to justify its valuation. It's worth looking at Tesla's revenue growth. Here it is. It eked out a mere 2% growth in the last quarter after 4 straight quarters of decline. And it's hard to justify its valuation. It hit new record highs without a growth narrative. So that could create problems. And although last year was good, it reached new record highs, as we said, it was heavily outpaced by its magnificent 7 peers. And the new year is negative. It's in the red. And it's no longer the most valuable company in the world. It was surpassed by Microsoft, which of course is driven higher by its leading work on artificial intelligence. Now, given that, with no growth narrative, I wouldn't be surprised to see further drop in Apple back to the back to the October lows. But as long as it defends the 200 period DMA, we could see a renewed effort higher and potentially new all-time highs. Of course, not all is bad for Apple. Apple is still a great company that has great products and no doubt can compete on many arenas, even if it's not the front runner. And of course, its main sale revenue source is the iPhone, and the smartphone market seems to have bottomed out, so that could have a positive effect. That's it from me for today. We will talk again in 2 days on Thursday, 10 minutes before Wall Street opens. Thank you for joining me.